figure we'll get started. It looks like it's just going to be a little more intimate. It's going to be me and the rest of you guys. If you have questions or want to talk about something, feel free to raise your hand. I can even kind of let you speak if you want everyone else to hear what you want to talk about. But I wanted to start with a couple of topics. The first one that you guys probably don't know very much about, is tax sales. So I kind of got my hands dirty on this recently. And this works pretty much the same way throughout the state. Every county might have a little bit of a different process, but here's how the state law works. Let's say you don't pay your tax bill. I think the due date is March of every year. It's late in April. By the end of May, by June 1st, they actually sell the lien, the tax certificate, to some third party. So it's kind of a wild process, and every state does it differently too. So you kind of have to familiarize yourself with it. But basically, a third party, some private company or individual, is looking to make some sort of return when they pay the money. And for the county's perspective, they get paid. So the county just cares about their taxes getting paid. They don't want to go through this whole other process of evicting an owner or even, taking title to the property. So they just they shoot that out. They sell the tax certificate to a buyer. And so let's say it's me. So you guys are the owner of the property. I buy your tax lien as soon as I can, June 1st of that year. So now I am owed interest on that tax lien. So let's do some round numbers. Let's say it's $1,000 tax bill. We would wish that we would have $1,000 tax bill. So we have $1,000 tax bill. I buy it because you were late. And then what that allows me to do is I bid not an amount. I don't bid like $1,200 to get your $1,000 tax bill, or $800 or $700. What I bid is interest rate. So I'm going to say, hey, I'll buy this and I'll accept a 1% interest rate on your tax bill. So Mike, I just bought your tax bill. Welcome.
That's a nightmare.
It's a nightmare. Yeah. So Mike didn't pay his taxes, his property taxes. I buy it off of the county. So the county gets paid. And I agree to accept a 1% interest rate annually. Now, that is good for up to 7 years. So if I want to just earn an interest rate for up to 7 years, I probably can. I can just hold that paper, hold that certificate for up to 7 years. At some point, the thinking is that the owner of the property will pay it back. They'll buy me out. They'll give me whatever I paid plus the interest that I'm owed back. And there's some county cost. There's some like initial interest rate that's a little higher. So I get made whole. I get my interest plus the amount that I put down. And Mike, you would get your property back. And you have up till 7 years to do that. So that's the first step. Mike, you pay your property tax bill every year?
Absolutely.
Absolutely. All right.
Actually, if you think about it, it's a great thing for the county because they in effect get paid off early,
Yeah, the county gets to wash their hands of it and moves forward to what we actually, what they're trying to do, which is run the government. Now, here's the next step. This is the part that people are playing, this third party, because the interest rate is pretty low. 1%, I can get that, somewhere else pretty easily. Why take a risk? Why be this debt collector? So the next step is as early as 2 years in. So if I buy this tax lien June 1st of 2024, 25, 26, come June 1st of 2026, I can actually initiate a tax sale. So I can convert that tax certificate into an auction. So let me share my screen and I'll show you kind of let's see if I can find it actually. I think here it is. Okay, so this is lienhub.com. This is what all the different counties in Florida, at least most of them, will use. You can see here, it's not every county, but there are a lot of them. And we're going to go to think I'm already in Collier County, maybe that's why. Let's do Lee County. So we're looking at Lee County. They have a calendar of auctions. So it looks like list of properties is May 1st. You have to register by May 17th to be a bidder. So we've already missed that deadline. May 21st is the first batch of sales, and this is for the tax certificate. Payment due for those bidders. So if I bid, $1,000 at 1% interest to buy Mike's tax certificate, I have to make full payment by May 23rd. And then the estimated date refunds of the unused deposits will be issued. I'm not going to get into the nitty gritty, but basically all the bidders have to put up some sort of security deposit. And if they don't win one of the bids, they get their security deposit back by June 4th in this case. So that is, that's how you bid that first stage. Now I'm owed, per law, I'm owed my interest rate back once the homeowner pays this back, once they redeem it. Then you look at the advertised list. Oh, no auctions running for Lee County. Let's see if we can go Collier County, advertised list. All right, here's Collier County. This is 100 different homeowners that had their liens for sale. So this, let's look at this one here. They're mentioning it is homesteaded property. They've got your legal description. There's the account, the face amount, $340. So this lady didn't pay her $340 tax bill. Maybe something happened. Maybe she passed away. Maybe the mail got lost. It's hard to tell. But there's not a whole lot of cost to buy this lien. You could get your 1% interest rate back, but you probably will get paid back. There, most likely this is not a huge bill that the homeowner just can't afford. This was probably some sort of miss. They forgot. They just missed it. It does look like it's a 5-acre property. It's been homesteaded for a long time. Maybe she passed away. It's possible. But if you were to bid on this, you could have a really low interest rate and just take the chance of step number 2. All right, you with me so far, Mike?
Yeah, is this the auction that takes place down at the Collier County Courthouse?
No, not this one.
Okay.
So this is the initial, you do it all online. And you basically are just buying that tax lien. You're not buying the property. You have no ownership of the property whatsoever at this stage. However, fast forward a minimum of 2 years, you can then initiate the actual change of ownership. So this is just the tax certificate basics. And then you go down here, the tax deed application. So the holder of a tax certificate, so I've bought Mike's tax certificate, at any time after 2 years have elapsed since April 1st of the year of issuance of the tax certificate, may file the certificate in an application for tax deed with the county. So you basically tell the county, hey, I want to foreclose and I want to put this property up for auction. I've held this tax certificate for at least 2 years and I want my money back. I want to either take the property or I want to be paid. A certificate holder who makes application for a tax deed shall pay the tax collector at the time all amounts required for redemption, plus interest, any omitted taxes, interest. So basically the county's saying, all right, if you really want to do this, you got to make us whole. It's not just this 1 year that you bought. You're going to have to pay for all the tax certificates that this homeowner is delinquent on. Maybe the next 2 years or previous 5 years, it'd be hard to tell. Each property might be different. You can imagine once you've bought one tax certificate, you're likely going to have the homeowner not pay the next year or the year after that. Once they missed one, they're probably going to miss all the others. So basically, you're going to have to make the county whole and all the other tax certificate holders whole as well. Let's see. In addition, the certificate holder shall pay the cost of resale, if applicable, and failure to pay such costs within 30 days, it should go back out of the application. Tax collector will certify a list of all persons required by law to be notified. So basically, they tell all the homeowners and their descendants that, hey, this is going up for sale. If the property is purchased by a person other than the certificate holder will be reimbursed all the sums paid plus 18% interest. So even if I don't win the auction, so now I'm bidding on the actual property, it's going up for auction. If I don't win it because someone else outbid me, I still get my money plus 18%. So it's a very interesting process. Ultimately, it's up for auction. If you don't pay your taxes, it will wipe out a mortgage, it'll wipe out prior homeowners, it'll wipe out the current homeowner, any tenants that might be in place, all that stuff could be completely wiped out. So that's what we call a super lien. That's why the lenders care about taxes, super lien. Mike, does that make any sense?
Yep,
It's a little intense, so make sure you pay your taxes, right?
yep.
Now, this is also why lenders care that the taxes are paid. It's why they always escrow for taxes, because if their lien means nothing if it gets sold at a tax foreclosure auction. So I just thought this was really, really interesting. We found a couple of properties. I have a client that they've had trouble paying their tax bill. I think there's some sort of family dynamic. They know it's owed, but they were expecting someone else to pay it. It never happened. And then every year they're behind the 8 ball having to pay this. Interestingly, I called the county on one of these because they're actually pretty helpful. You call the tax collector. And on the property I was looking at, it was a $5,700 tax bill with interest that had accrued since March. So March, it was like a $5,000 tax bill. In the next couple of months, it had become as much as a $5,700 tax bill. And then June 1st, Collier County will sell the certificate at auction. They absolutely will do that. After June 1st, if you want to redeem it, there's an immediate 5% fee added to that. So you're at like $6,300. And then July, it adds another 5%. I think the first 3 months, it's 5% every month. And then after 2 years, they could ultimately go to auction and sell it. So it's something that in my scenario, it came up because it's a potential listing. And the listing agent was a little freaked out because she's like, wait a second, what's going on? I see all these violations. I see tax sales. Who am I working with? What kind of seller is this? And ultimately, this is not hugely scary in my mind. It's just a money thing, but it could easily freak out a buyer. And Mike, that leads to another thing that you and I were dealing with. We both got copied on an email about some code violations on a property. Now, do you remember the tone of that email? Was the buyer like, oh, it's not that big a deal, or was the buyer kind of freaked out?
Well, I think there was definitely some concern there.
Yeah, they were
We
freaked
don't
out.
know what the violation is.
We don't know what the violation is. We don't know, who is this seller? Who do we trust? Is this a real deal, or are we getting scammed? That was something that you had mentioned, Mike, that like, is this a scam? And I think that that's a presumption that's hard to rebut, even if it's completely unfair. In my experience, the ordinances, the code violations, the tax certificates, we can pay that all at closing. It's not a big deal. That's fine. But if it sabotages the goodwill with your buyer, if they don't trust you, if they don't think they can trust you, it makes your job really hard. Does that sound right, Mike?
Yeah, it sounds about right. What auction takes place down at the county court steps? Because I attended a couple of them.
Yeah, so the second version, that's phase 2, does take place down at the courthouse. So the clerk of circuit court does the tax deed sale, and those are usually done down at the clerk. Also, you would have HOA liens can be foreclosed down at the county. HOA liens are not a super lien. They are, they're junior liens. So they would come after a mortgage. They would come after a second mortgage potentially. But they can, they can wipe out anything past them. It can wipe out mechanics liens possibly and things. But, in the scheme of things, tax deed is superior, tax lien is superior because it wipes out everything else. But a mortgage lien, that's the other thing that goes down at the county as an auction. They're kind of fun. They're a little intimidating initially, but you kind of get the feel for it. You got to do your homework ahead of time. And the number one trick is you got to have cash. And I guess the other trick is you got to know what you're buying, because are you buying a tax lien, which is a really great thing potentially, or are you buying a mortgage lien, which is still subject to the taxes? You know, that you still have to kind of pull it out of that issue. Or are you buying an HOA or a condo lien, which is still subject to a mortgage and taxes? So you don't want to spend $500,000 on an HOA lien if you also have a mortgage lien of 500,000 and a tax deficiency of 50,000. The value might not be there. But if you spend 500,000 on a tax lien, well, nothing else will be there. Everything else gets wiped out. So it's the research is a lot simpler.
What I noticed when I went down there, Christian, and I went a couple weeks in a row, and the same group of guys was going to each one, investors, I guess.
Yeah.
And I think they almost had a gentleman's agreement on who would bid on what, you know, because they didn't want to go against each other. It was very interesting just observing the process. But I literally saw a young guy who was probably in his early 20s pick up a property for under $1,000. I was stunned, and I figured the lender didn't show up. Yeah, I still don't understand it, but it was very interesting to watch.
Well, I would tell you it's most likely, Mike, what you were seeing is it was not one of those primary liens. It wasn't a senior lien holder. They were still subject to a bunch of other issues. You know, so like, for example, you buy an HOA lien and there's still a $500,000 mortgage, you're going to spend $10,000, $20,000, $30,000 on attorneys just to get a payoff. So that's something people don't really understand is once you buy that lien, and all right, you're the title holder, this is your house, Mike, it's a condo lien. That's all it is. So now you have to get that prior homeowner's mortgage paid off. And that could be hundreds of thousands or more. And it's almost impossible to get the bank to give it to you because you're not the borrower. You have no standing. It's a confidential thing. It's like asking for my medical records. It's not going to happen. So you have to hire an attorney to compel the bank to give you a payoff. I've done a lot of them. They're not fun. They're really hard, really hard.
Well,
But
that
determines your price.
Your advice on know what you're buying is spot on. Because what might look like a great deal, if you really don't know there could be mold all through that house. I mean, you just don't know. Yeah. You need to know what you're buying.
I would say in my career, it's almost once a year, I get a very panicked buyer. And unfortunately, a lot of times it's a realtor. The realtor wants to play. Their clients know the business quite well, and they've made a lot of money, and so the realtor gets involved. And then they call me and they freak out because they didn't realize it was subject to 2 mortgages. So they bought the second mortgage, and they're like, "Oh, this is a great deal. I only paid $250,000 for it, and the house is free and clear." Not so fast. You paid $250,000. There's another $300,000 mortgage there, and now they're underwater. That's why they won the bid, because everyone else realized you overpaid. And that's not even considering there could be back taxes. The house could be in disrepair. You have to be very careful. It's a dangerous game. I think the first couple of months that I had moved back to Florida, my neighbor called me panicked. She was crying hysterically. They had bought a condo lien. I think they paid $55,000. But they realized they bought the wrong lien, the wrong house. They were confused. They were a little upside down. And this lien was kind of null and void. It had no value whatsoever. And they paid $55,000 for it. They thought they got away with something. Luckily, we were able to get that client their money back for some other reasons. But be careful. There's no get rich quick scheme. I promise you, there really isn't. It's a challenge. It's a challenging industry. I haven't even been that familiar with it. I promise you, if it was easy money, I'd try it, but I don't think it is. Speaking of easy money, Mike, you ever heard the term bridge loan?
Yep.
What do you think it means to you? This is not a trick question. What does bridge loan mean to you?
Well, I guess on the surface, to me, you're in a predicament and you just need a short-term loan until something happens where you can get what you really are looking for. So you need some money to tide you over from point A to point B.
Right. Is it a mortgage?
I'll defer to an attorney on that one.
Excellent, excellent answer. It might be a mortgage. So bridge loan is a very generic term that you use to get you from one area to another. And in our case, we're talking about just finding a way to buy this house. That's what we're trying to do, trying to buy the house. And we need, there's a little bit of a disconnect. Maybe our other house hasn't sold. Maybe we're waiting on an inheritance. Who knows? Maybe they're waiting for their company to sell. We have that happen quite frequently. So their company is supposed to sell. It's been delayed a minute, but we found this house in the meantime. We need a bridge. We need to be able to get from here to there. So it's a very generic term. And ultimately what I want you guys to think about when someone says bridge loan is you have to ask for clarification. What kind of bridge loan are you seeking? Because there are 1,000 different kinds. It could be a home equity line. So they might want to borrow money from their existing home so that then they can pay cash for this new one. That is one version of a bridge loan, a home equity line. There are a couple of tricks with home equity lines. Number one, you cannot be selling or listing your home that you're getting the home equity line on. It cannot be on the market. It cannot be under contract. And the main reason is because lenders don't want to waste their time. They don't want to give you a 2-week loan. It's just not how these home loan companies work. So that is the big rule, is that if you have their house listed and they find something and they're like, oh, we'll just get a home equity line, I can promise you they're not going to be able to. Not a home equity line. Maybe some other type of bridge loan, but not a home equity. Have you heard of that before, Mike? Where there's some certain restrictions like that?
Yeah, it's interesting. For some reason, this reminds me of the short sale period we went through where, whether or not your house was listed for sale was an item that had to be discussed.
Yeah,
So
that's a good point. There are those sorts of rules around whether they'll allow you to get a home equity line or a short sale. They want to know how diligently have you tried to market this property before we agree to this price. How hard did you really try? That's where that matters. But the home equity line, they're really just trying to protect their time. The lender doesn't want to spend 3 weeks getting you this bridge, this home equity, just for you to pay it back 10 days later. They don't like that. And in fact, generally, the loan officer does not get paid if you pay off the loan within 6 months. So that's where these bridge loans can be really tricky, because you want a short bridge, but the lenders, they're looking at how much they can make off of it. Otherwise, they'd rather not do the deal. So you have to kind of keep that in mind. All right, so that's bridge number one, a home equity line. Generally, it has to be their primary residence that they are borrowing from. You can't usually get a home equity line from some investment properties or a second property. So keep that in mind generally. Another kind of bridge loan would just be a mortgage, just a general home loan. So Mike, you find the house you've always wanted, you haven't sold your other one, well, we'll just get a bridge. And that could be borrowing more on a conventional manner where you're just getting a loan with your purchase. And I think that's a great option. Even though it sounds more traditional and you would just call it a mortgage, that is a bridge, because in your mind, you're just going to keep this loan for a short period. Once you sell your other house, you'll pay it off. Once you retire, you'll pay it off. Or once I start collecting my pension, I'll speed up the payments. It's a bridge. It's all it is, getting from one place to the other. Another type of bridge loan would be like a 401k advance. So you actually take money, you take a loan off of your IRA or 401k, with the intention of paying it back in so many days. And the statutes change all the time, but it's federal law allows you to borrow, pay it back with interest. You're basically borrowing from yourself. That is absolutely a bridge. I think you have to pay a 401k loan back in 5 years. I think that's the maximum you can borrow the money. After the 5 years, it's not considered a loan. They consider it a distribution, and you'd pay taxes and penalties on that, depending on your age. So that's a bridge. Absolutely. Borrowing from your 401k. Mike, question for you. On that kind of bridge, is it a cash deal or is it a financing deal?
I have no idea.
All right. Great answer. Because I don't think a lot of people understand how to write that up. Yeah, if that were the case, if you're borrowing money from some other source, it is not a mortgage on this new purchase, then it is a cash deal. As far as the seller is concerned, you're borrowing the money from your 401k, or you're borrowing the money from your checking account, or you're borrowing money from a home equity line. The seller doesn't care. You just have to have cash. That's a cash deal. The only time it wouldn't be that it would be financing would be if it was a mortgage, more of a traditional mortgage that you were just finding a bridge for. Another one for you, Mike, would be a loan against your brokerage investments. So it's not retirement money, it's just your brokerage investments. And this is the one we see a lot, especially here in Southwest Florida. So Mike, here's the scenario. You are incredibly wealthy. Congratulations. You've got $20 million in your brokerage account. It is not a retirement account, it's just your brokerage account. And you call your investor because you've got plenty of money and you're like, hey, I'm buying $1 million condo down in Naples, Florida. I'm really excited. I need you to wire my deposit and then wire the cash to close to Ross Title. And your investor says, great, congratulations, Mike, but why would you do that? And you ask, why? And the investor says, or the wealth advisor would tell you, well, number one, you're going to have taxes. So, let's say you're that $20 million man and you're in the 40% tax bracket. You will have to pay 40% just to take your own money out. And they say, well, why not just get a loan? We'll lend you the money. You keep your money invested with us. So you keep the $1 million invested with us. We earn our fee based on how much is invested with us. So we keep $1 million in the pot and we'll give you a low interest rate on a mortgage. And your stocks and bonds, your whole portfolio will be the collateral towards this $1 million loan that we're going to give you. And you're like, well, that's incredible. Where do I sign? It's that simple. That is a bridge. Sometimes it can be more long-term, but it's typically, something that you negotiate directly with your wealth advisor. The more money you have, the more likely they are going to want to keep you and give you those good terms. I've seen loans on those types of deals at 1% or less. Really nice, like, you have a client buying a $10 million house and their brokerage will give them the loan at well below market rates. And it could be a 30-year mortgage, it can be a 10-year, it's going to have margin calls. So just like any sort of margin loan with a stock portfolio, if the value of your investments goes down to a certain level, you're going to have to pay back some of the loan or bring in more investments. So they want to make sure that they're not taking a huge risk. And they're double dipping. So it's really a good deal for them. It's a good deal for your client. It actually kind of works both ways because you're not hitting the big tax gains. You're not gonna have to take out $1.5 million just to have $1 million at the end of the day. And that is a bridge. On that deal, it's still a cash deal, still a cash offer. And now here's the real trick, Mike. How do you, if the listing agent asks for proof of funds, what do you do?
Well, I know we've had agents reach out or have their clients reach out to get something from the brokerage. I'm not sure what document they get from them, but basically it's you've got to be able to prove that they're capable.
Yeah, it depends where you're getting your bridge from. So if it's a home equity line, I would say, look, here's the terms of my home equity line. Now, typically what I would recommend to a buyer is the home equity line should already be done. It should already be approved. The money is there and I can just pull on it, in which case there's usually a statement, your most recent home equity line statement, that shows how much is available to draw. Like for me, I have a, let's say I have a $250,000 home equity line that I can pull from. I would show, all right, look, seller, I have my 250,000 available to draw at any time. Here's my statement. Here's the home equity line, and you're welcome to call the banker if you have questions. Alternatively, if it's a brokerage account, the wealth advisor could actually show how much is in your brokerage account. They don't need to know that you're borrowing from it, or maybe you want to show that instead. Maybe the wealth advisor is going to commit to borrowing $1 million off of their existing brokerage account. There are ways, ultimately, there are ways to get it done. You won't be able to show the cash necessarily, but you can show that you do have the ability to get the money for closing. It's not a problem. It might be something you're not familiar doing, but it is very common, and I wouldn't overthink it. But in all those cases, it is a cash deal, and you can tell just asking or being told that it's a bridge loan probably isn't enough questions. You should ask the next question. Mike, I'll give you an example. One of the very first jobs I ever took was with a new office in Atlanta. And this was a big company, nationwide, big company that I was taking right out of law school. But the office in Atlanta was brand new. And there was a lot of excitement, a lot of enthusiasm. But when I sat down for my interview, the manager told me, he said, "This is a very entrepreneurial office. You'll love it here." And I'm like, cool. I always wanted to own my own business. I always wanted to be an entrepreneur. But what I didn't do was I didn't ask what that meant. I made assumptions as to what that meant. And then I, made a mistake ultimately in taking that job, because what he really meant was, we don't have any clients. We don't have any clients. That's what entrepreneurship meant to him. I'm going to have to hit the ground running and go get my own clients. And at 25, that was a tough one. That was a tough pill to swallow. So that would be my suggestion to you guys. Ask that next question. What kind of bridge loan are you referring to? What are you trying to do to get it? Another bridge loan, Mike, one we didn't talk about, seller financing. Seller financing is a bridge loan. Not every seller can do it, but if they can, it can bridge the gap between the buyer selling their other property or selling a company or whatever it may be. Can I give you an example? So we have a client right now, a seller who was approached by a buyer, full price, but they said, we don't have all the money. We can give you a third of the money now, and then we'll lease it from you for the next 12 months. And then 12 months from now, we'll give you the rest and we'll close. And the seller was interested. They were okay with this. They were getting full price. They were getting interest on this lease. They were getting money back for this lease. It was valuable to them. They knew that the buyer was committed because they had all this money down as a security deposit. And they could wait a year. They could wait a year. The problem I was having, though, was this is really just a bridge. We're just trying to create a bridge here. There's got to be another way that reduces the liability on the seller and gives the buyer more advantages. There's got to be a win-win. And seller financing was the win-win, because if you're a landlord for 12 months, you are still subject to liability if someone gets hurt, if the house burns down, if the taxes go crazy or the insurance goes crazy. The landlord still has a ton of liability or an exposure to these ebbs and flows in the market, and this house particularly. I always worry that if someone, if you threw a party and a guest fell down the stairs and they were drinking or something, or they got in a car and hit someone on the way home, the owner of the property could be sued for liability. There's no insurance in the world that'll 100% protect you and let you sleep well at night. So instead, what we negotiated was a seller financing. We would actually close in 30 days. The buyer's security deposit will be converted to a down payment. And the lease will be converted into mortgage payments. And so what that did is it allowed the buyer to file for homestead. It is the buyer's house. They can, join the HOA, be a member at the club, and they can write off the interest on their taxes because now it is mortgage interest that they can write off correctly. The seller gets to just be a lender. They don't have to keep the insurance going. They can monitor from afar. They don't have any direct responsibility other than they are a primary lien holder. And it's 12 months. It was pretty short term. The buyer had a reason for needing 12 months that checked out, that made sense. You know what the other benefit was, Mike?
Yep.
Everyone got paid in 30 days as opposed to 12 months. I got paid sooner. The realtors got paid sooner. And the seller, that security deposit, now that was money in their pocket. You can do more with it. As if it's in my escrow account, it doesn't help you very much. If it's in your pocket, you can actually spend it. So I love that, asking those questions and just saying, there's got to be an easier way.
I think you hit the nail on the head earlier, Christian, when you said it's got to be a win-win,
Has to
because
be a win-win.
you got to realize that the seller potentially is taking that property off the market. Maybe it's in season and they don't want to miss season. So what's in it for the seller
Yep.
to agree to that? So it's got to be a win-win.
Now, this one of the sellers was a husband and wife. One of them freaked out a little bit because I think her dad had some prior experience. And so in this prior experience, there was a 12-month mortgage. And at the end of the 12 months, the buyer just said, look, I can't afford it. The house went down in value. It's no longer worth it for me to pay off this mortgage. Got to work with me. Got to give me a discount. I know I owe you $500,000, but will you take $450,000? And so she was pretty bitter. The wife was pretty bitter because she's like, my dad went through this and it was awful, and I don't want to do that. I said, but there's one big difference. In this case, you have 1/3 of it already paid down. So let's say it's $1.5 million sale price. You already have a $500,000 cushion. If the property goes down more than $500,000 in value, yes, there are going to be some issues, and that is more like a short sale potentially. But that's why you have insurance, because you can keep the house. If the house burns down, the insurance company will rebuild it. You make sure the taxes get paid, and the chances that things are going to go down 33% and the buyer not pay you back, unlikely. And the buyer signing a promissory note. So let's say the house does go down in value. Well, they still agreed to pay you back $1 million. They guaranteed it personally. So even if the house isn't worth $1 million, you can sue the buyer for non-payment of that promissory note. If they have any extra money, you could go collect it. So you could go collect the house, you can put it up for auction and get your money back that way. You can sue the borrower for any deficiency in the payment. There are a lot of protections. Alternatively, if it was just a lease, the most you can do is a victim and maybe get a judgment for anything back owed or whatever it may be. It's a little different. It's not as good. It's not as good of a protection. That's a fun one. I just think you gotta look at simply. It's got to be a win-win, like you said, Mike. And if it's not, then it's not going to work. But if it is a win-win, like in this scenario, I was able to show to the buyer why they should want to do it. They can file for homestead. It's their house. They can make whatever changes they want. They can control it. They could sell it. That was the other thing. If the buyer was having financial problems, 6 months in, they could put it up for sale. They're the owner. But if they're just the tenant, putting it for sale would be almost impossible. Maybe they have the right to or the option to buy, but actually selling would be really, really hard. All right, Mike, any other thoughts? Anything else that's going on in your world right now?
I'm learning very quickly that if you're a panelist on this show, that, man, you're fair game.
Yeah, and I appreciate that, Mike, more than you could ever imagine.
There you go.
I do think we had one question. I don't know, Larry, if you are interested. I knew you had your hand raised earlier. Do you got anything going on in your world? You'd have to unmute yourself. I know he had raised his hand. Let's see if he has something. Does anyone else have anything? There he is. What's up, Larry?
Hey, actually, you and Mike hit it spot on when you were talking about the the 401k plan and being able to take a loan against that and so forth. And that being a cash deal. So no, we're good. We're good.
Good, love it. I actually used my, I think I had an IRA that I borrowed from, and at the time, it might still be the same, but at the time, I think I had 60 days to pay it back, and there would be no penalties, no taxes, no interest. So looking at, and I think I needed, you know, 30, 40, $50,000. You know, explain to the lender where it was coming from. That was part of my loan application. And then when I sold my other house in Georgia, I was able to take that money and pay back what was owed into my IRA. So it's a very normal thing, not a huge risk. The biggest risk would be if I didn't sell my other house and couldn't pay back the money that quickly. So, you know, just knowing your options, knowing where the obstacles could be are very helpful. Thanks, Larry.
And, you know, a lot of folks, you know, if they do it short term, like you just mentioned, then it could be a really, really good option for them. But sometimes if somebody is going to drag it out for 5 years, and a lot of 401k plans, if it's a primary residence, then they'll allow you to stretch it out over 10 years. And, you know, if I put on my financial planning cap, then I always like to share with clients that keep in mind that there's no such thing as a free lunch. So you might think that you're borrowing your own money and you're going to credit your own interest back. But let's talk about some of the hidden expenses that maybe you're not thinking about if you're going to go longer term. And one of those could be when, you know, they may have paid in pre-tax dollars, but oftentimes when they're paying the money back, it's going to be payroll deducted and it's going to be with after-tax dollars. So Mr. and Mrs. Client, you got slapped on the wrist one time by paying with after-tax dollars back into the plan. And later on, when you're pulling your money back out, you're going to get slapped on the wrist again, paying taxes on those taxes, interest again. So you got hit twice with paying taxes on those on that interest if you drag it out for long term. Yeah. And then, Mr. and Mrs. Client, you also have to take into consideration that let's say you took the money out now when the market was at a peak, and then all of a sudden you're paying back over 5 to 10 years, and there was a 30% hiccup in the market. Well, you know, or let's say the market, was at a peak, and then all of a sudden it's, you're paying back money, and now you're paying it back, you know, as the market's going up. Well, you're losing money there.
Missed out. Yep. Yeah,
you know, you didn't buy low and sell high. So I just always like to point that out to some of the clients, in case they're going to go in for the long haul, 5 to 10 years.
Oh, I love that. I think ultimately, though, you have to have these contingencies, plan it out in advance. This should not be something that you're trying to do the week of closing. It should be done the week before you go under contract. You know, I think a lot of buyers, they get this false hubris where they're like, oh, we're paying cash, we got plenty of money. And then 2 weeks before closing, they talk to their wealth person who convinces them to do something else. And now they're under the gun. We do a lot more mortgages than most people would think, even though almost every one of my clients could simply pay cash. They tend to be convinced by their wealth person to get a mortgage. And so the sooner you think about it, the sooner you have those conversations, the better. And I think it's our job to just kind of prompt our clients to think that way and say, hey, look, get the insurance. Let's call them now. You know, no time to waste. It's one phone call. Call your wealth person, make sure that they're on board with what you plan on doing, that there isn't another option. Don't bet it all on being able to sell your other home in, you know, Connecticut or whatever it may be. Don't put all your eggs in that basket, because you'll never really, you know, you won't give yourself many options later down the road. But thank you, Larry. Thank you, Mike, and good luck, everyone. If you guys have questions about this or anything else, don't hesitate to call. Bye, guys.
Thank you.
Thanks, Larry.